10 points. So that means that we get this plus or minus 10 on either side. And that's what we're going to be looking for, is that plus or minus 10. So when we think about that type of rotation, we're then led to the idea of how the rotation showed up on this screen. And obviously, when we look at the rotation on this screen, we can understand this from an S&P point of view. We can understand this from the total size of things like oil prices point of view. 10 points, 10 points. Total range, 20 points, right? So if we've got a high price here of 10 and a low price here of 10, you know, so we're going from 0 to 10 on the plus, 0 to 10 on the minus, or on oil, for example, 50 to the upside, 50 to the downside. So this would be, for example, oil, and the other one would obviously be the S&P. So we'd have oil here, we'd have the ES here. We can obviously see those rotations. Inside of those rotations, we can see that we have these 10-point blocks. 10 points to the upside, 10 points to the downside. Now, that's the S&P, of course. If it was oil, you'd say, well, 50 points. Now, obviously, this is always subdivided as well. So 50 points on oil, 8 points on the bond. And you can obviously see these are areas. 50 points on oil, 8 points on bonds. And that puts us into these boxes. Now, I'm not saying that that's always the case, but the market maker starts out with the inverted commas normal. Because if you're ever doing any relative value ideas, you always have to start out with what normal is. And normal in the markets is a hard one because normal changes every day, right? Because volatility changes every day. News data releases make volatility higher or lower. So we know that volatility is going to extend, so the boxes will extend by default, correct? That's what volatility is an extension of the volatility, extension of the ranges. So what it means is that we can still see prices sweeping outside of these areas here, for example, and here. But as a rule, the balance of that area, the balance of this area is where you then suggest that the market maker will play around, and that'll become a new balance. And I'm not saying it's a buy trade or a sell trade, but the interesting thing is the guys that came into the London session will tell you, we called 3 balance areas today. 3. We've called since the London session opened. Guess what they were? Well, let's take a look. On bonds, we called, at the time we started the classroom, we had one starting, which was the bond. And we had a buy on bonds at 13. And we suggested it would trade 2021. And it traded from the call. This is where we made the call, around about 11:30 this morning. And the trade came off 2013s and it traded 2021s. Exactly as we thought it would. The second trade we suggested and live in the room was a buy on the S&P at 22. Agreed? So we bought the idea of buying the S&P around about 22. The price at 22 rallied up to 38s. So that was the second trade we called live in the room. The third trade we called live in the room was oil. Did we call oil? We called oil. So the third trade we called in the room was oil. We called this oil price here at 75, 76s. We got a buy side bounce, and then the second trade we called was a buy trade at $81.50. And we got a price of $81.50. So I said 3 that we've called. We've actually called 4 because the oil had 2 trades. We had a buy trade here potentially as far as the bounce was concerned, and we had a buy trade there potentially on that data release. That was worth $700. In other words, the 4 trades that we've called live in the room based on these market maker auction levels have had 4 winning outcomes for well over $1,000. In fact, over $2,000 now because of the bounce that we've had on the oil. Per contract. Simply from those elements. So when you think about that, you think to yourself, my God, that is really quite special. Well, let's think about this oil trade. If you think about the oil trade, the sell was a balance here, right? And the balance was around about 15s. We knew the balance would come in about 15s because we saw where the buy came from. Now, we don't want to keep going backwards, so I want to go forwards. So on the basis that there is a balanced seller coming in at 15s, we asked everybody in the classroom to start working on this. And this was this sell trade here. It did extend higher to around about the 25s. It went a little bit above the 25s, and we started to call out this 2025 area. From the 2025, we then asked everybody, what price would the trade go to? And we come up with 50 points. We come up with 75, right? 25 to 75 is 50 points. So we know there might be some action around about the 25 point, which is the quarter. We then know that the big action will take place at the 50. The big action took place at the 50 and the price bounced for 25. When we get a sell coming back off the 82s, we know the target price is 81.50. Yes, 81.50, because 82s to 81.50s is 50 points. And we drew this out before that took place, this oil trade narrative of 50 points, 50 points, 50 points. We had that information before all of those things happened. So in other words, those that were in on the London session were able to pick up on that 50-point opportunity to buy oil. And obviously, if you bought oil at that point, with the dollar getting murdered, with the dollar getting murdered and the supply line flat, this was an absolute walk in the park to buy $81.50. And if you buy at $81.50, that's not the price you take. You take the balance area if there is such a thing. You don't take the bottom tick price for these ranges, because the market maker doesn't work on those. They work on balance areas. They don't work on the rejection of a price. They work on a balance area. So we don't use the high of this at 82.05. We use the balance of this area at 82s. And we don't use the pin rejection here at 81.50s. We use any crossing over, a balance, a wholesale price, and we start thinking about that price area as a probable trade level. And it doesn't mean you're going to get a sell at the next price. There's still got to be a reason why you want to take the deal. And the market maker's doing the same. They're going to be looking around those prices. They're going to be thinking about it. Obviously, they're going to be factoring in the wholesale price level of 1400 hours, surprisingly enough. You're trying to get positioned at that trade to try and figure out what you're doing. You recognize the key reference in the background here. You recognize this key reference in the background here. And you're starting to recognize this as a high-priced oil. And you're obviously seeing that it's all supply-led. So obviously, you're thinking about that as a possible short sell regardless. This is a new wholesale price. And the fact is that the selling has now came in from this new wholesale price, and you could average this candle out around about 82.10s. You're obviously thinking around about 81.60s as a target price on the way back down again. 82.10s, you're looking at 25 ticks, 50 ticks. So you're obviously going to be looking at 81.60s as a new target price in here. And obviously that takes into account the upside movement of price. In other words, you're basically rotating price higher, but still inside the same range. And that's what you're supposed to do as a market maker, aren't you? It's not a static across the chart line, that assuming no trends taking place, otherwise you're going to get burnt. This is the whole concept of Z-scores. Z-score is not a static. It's moving against the moving average, of course. Z-score works out the standard deviation against a moving average price. And therefore, you get the two standard deviations against a moving target, basically. And that allows you to see that the trend is increasing on the upside, and therefore you want to be more aggressive on your bids and less aggressive on your offers. And that's absolutely do-dandy. So we can see those aggressive bids coming in already. And where did they come in from? Well, if we went 15s, we're thinking about 25. So we're thinking around about the approximately around about the 85s, perhaps, possibly the 90s. And obviously you start seeing the slowdown. You're waiting to see if any value comes in. Obviously, I don't really like the buy too aggressively because of the supply line, but obviously we've just picked up some real money demand, and it's obviously scalped off because of the dollar. So I don't actually like any trade in here at the moment because of the difference in opinion between the dollar and the supply line. So I don't like any trade at the moment. So I'm happy to not be involved in this at this stage. Now, obviously, we've overran the trade, the idea here, and we haven't even touched yet on the S&P. So I want to quickly touch on the S&P before we lose track of what we're trying to do here. The S&P trade is very, very straightforward. Very straightforward. It's the scalp trade that everybody on the floor knows about, and it's basically the underlying adding or subtracting of liquidity by the market makers. And all you need to do for the S&P trade is look at the tick versus the prem. That's it. The tick is what the underlying stock market is doing. The prem is how much discount you've got on the futures. Does that make sense to everybody? So for example, here's a trade that I took yesterday because I knew I was going to be doing this classroom, and I wanted to make sure I had a classic example of the trade. There it is right there. We get the prem upticking, we get the tick down ticking, and obviously we get a perfect example of a sell trade. The prem shows that the S&P is at a futures at a premium. The price is not going higher, so it's being absorbed. So that premium that you're getting on the future is getting absorbed. With the tick dropping like this, I love this sell trade. Love this sell trade as a scalp. And obviously the sell trade as a scalp coming in back in off that trade is this screenshot. And you can see that we managed to get a quick trade on, made some easy money. And that's all you can ever do with these types of trades. Very, very easy trade outcomes. In other words, you're looking for the premium or the discount, and you're looking for the price action. And if you get the premium and the discount and the price action, you've got a very high probability trade. You can see the opposite trade takes place in here, because obviously you'd be looking at this candle, but that doesn't look as if it's compressing, does it? It doesn't look like it's being absorbed here. Well, you can obviously find indicators that show you absorption. Price action shows you absorption. I want to see a small candle so that I can see that price action. I don't want to see a small candle as in a huge pin at the bottom edge because you've given away most of your scalp price. I want to see a small candle though with a very large prem, suggesting that there is a buyer in that in line with the uptick on the tick. If I see it, I can buy into that. And you can see that 30 seconds later, I've made myself another couple of $100. Incredibly high probability scalping trade setups, so long as the other elements line up. Those other elements lining up, that's what we're looking for. We're looking for premiums and discounts. And as a floor trader on the floor of the exchanges, looking up at the big board, you're not seeing the prem. You're seeing the underlying stock market. You're seeing the underlying bids and offers on the stock market itself. You're seeing the tick. You're recognizing that stocks are trading on an uptick, and you recognize the future is trading on a downtick. And if you're on the floor of the futures exchanges, and you're looking at the future trading on a downtick, but the stock's trading on an uptick, you know that there is bids coming in terms of that liquidity. So you know that if you can see those bids, you can join those bids. And if you join those bids, your probability is a lot higher that you're going to make some monies. Like at the moment, any uptick, any premium in the S&P is a sellable opportunity right now, and selling off the 48s. And you can obviously see it's already started to come right off that 48 print. And you can see how easy it was to spot that sell at 48s there. You can see that the prem was starting to uptick. The tick was coming off really hard, not on the blue candle, but when the red candle started to retest into that, there was a very, very high probability short sell off the 48s, and it's already traded down to a low price there of 46s. So that's $100 in 30 seconds. $100 in 30 seconds on that scalp trade there, guys. It is a scalp trade, because obviously every candle has to be treated as an independent new storyline. It has a macro component to it, but obviously it's more likely to be a scalp trade based on price action compression. And obviously based on that storyline, you're looking for the story to evolve. If they don't evolve, like that blue candle doesn't evolve, you can obviously understand that that's not a sell trade there. So obviously what you're looking for is to make sure the S&P has a premium, make sure the price has not moved so that it's being absorbed, and make sure the tick is dropping. If you want to be bullish, of course, you want to make sure that the tick has a discount, that the S&P premise has a discount, and obviously the tick is rising. But this looks good for a top line short, and obviously anytime you can get premiums like this developing storyline here, but obviously you still need to see that premium being traded, guys. Just because it's upticking doesn't mean you're going to get short, because that doesn't mean anybody else is getting short. This means simply that this price is rising, and the price is rising. It doesn't mean it's being absorbed yet. You need to see the price being physically absorbed. In other words, you need either access to order flow, or you need some sort of tool that tells you absorption is now visible and you can now jump on board. In other words, you look at the delta. You look at the book, you look at the liquidity, and you take your shot. You take your shot and you make your monies. You get your stops at break even, and obviously you walk away. If you need to walk away, you're ready to do that bit of business and clear your books. Yeah. And that's exactly what I've just done. I've taken a quick scalp short. I took a quick scalp short. I got an easy stop at break even there. And I'll take a screenshot and I'll show you exactly what I just did there. So there was a trade I just took. You can see that the delta came in there. Do you see the delta in the background? I know it's a bit busy. Did you see the delta in the background rising? And can you see the tick in the background net falling? So I basically waited till I got the best possible price. As soon as I seen a buyer getting jammed, I brought up my sell stop order, popped in a quick short sell behind it, tried to grab a little quick scalp sell, and made some monies, made some easy scalp monies. Stops at break even +1. In this case, stops at break even +2. Just get a quick scalp, get some money, and walk away from the deal, walk away from the trade. And that's the scalp done. Now the tick's on an uptick, so I'm not interested in doing any selling. So obviously that's okay. That's exactly okay with me. I'm happy to just walk away and I can wait for the next opportunity. Tick NY. So we're using tick NY and we're using the S&P minus the SPX. So in other words, we're using the New York Stock Exchange tick and we're using the ES minus SPX for the Prem. And obviously you can do this on a 15-second chart, a 30-second chart. And, you know, obviously in the early stages, you're not going to see much because obviously this is obviously going to have a gap on it because obviously the Prem is going to go sideways, whereas previous it's just the S&P. So you're going to have to wait for that to balance up. You can still see it inside of these ideas. You can still see the story, but you've still, remember, got the key in this. It's all right seeing the story. It's all right as a local looking up at the big board and seeing that there is a value on this premium at the moment to sell the S&P with the trick coming down, but you've still got to see somebody selling it. If nobody else sells it, it's still too early to the party, right? You've got to see that delta getting trapped. It's got to be outperforming the tick delta. If it's not a sell trade yet. And at the moment, for example, the tick delta is outperforming the volume delta. And because the tick delta is outperforming the volume delta, you've got to be very passive. I would never enter this as a sell stop order. I would enter this as a sell limit order and a sell limit order only because it obviously has a lot of value to sell it, right? It's got a lot of value to sell it. And obviously based on that value, you're obviously wanting to get the best possible price. But because of the delta storyline, you cannot enter this aggressively. And obviously, if you took the trade that I took, I've already got a stop at break even. I've already made some money on that trade. I sold it to 9.5 on that one on the way up. So I sold at 9.5 on that one. On the way up, I was able to get a sell limit order filled, and I've been able to rotate the price down a little bit, make some monies. And obviously, the tick started to turn back up again. So I just took my profits, stops at break even very easily. And, you know, worst case scenario, I make some money or I make nothing. Worst case scenario, I make some money or I make nothing. Just because of the size of profit, Theo, I would suggest 15 to 30 seconds, but you're basically watching this in real time. I mean, you're not having to wait for the end of a candle, if you know what I mean. You know, this isn't based on an end of candle narrative. This is based on a live developing storyline in this area. So, you know, you're obviously just watching these stories and you can see the tick and the divergence in the background is quite strong. So I like the idea of getting short up here, right? But obviously when the volume, the delta and everything else was starting to drive there, it was a very passive sell for me at 9.5. So I was able to sell into that very passively. You heard that. I called it out live as it was happening. So we've got a little sell at 9.5 and now it's trading at 6s. It's an okay trade outcome, isn't it? Eventually, it's an okay trade outcome. And obviously, there's a short-term press on the tick here. We've just got to let that go through. And obviously, you're looking for the absorption. We've obviously seen the candles getting smaller and smaller and smaller. So you can see the absorption taking place, right? You can actually physically see the absorption. And obviously, it's just rotated nicely away. So we've got 2 out of 2 so far from the floor trader scalp. Now, obviously, in terms of that floor trader scalp, what is the storyline? Well, we still use the same idea. On the floor of the S&P, the idea was to try and make 8 ticks. The idea of any floor traders, unless you're obviously scalping the bid offer spreads, the idea was to try and make $100, make 8 ticks profit, because 8 ticks profit should be relatively safe to make. Well, you've went 50s to 48s, you've cleared 8 ticks, no problem, and it's up to you to decide whether you want to go for 8 ticks or whether you want to let it roll. Well, on that trade there, that could have been a buy trade in the very short term there, absolutely, because you can see on that candle, you can see it's a red candle with a very small body, so there is obviously elements of absorption, and you can see that it went from 5 1/4 to a high price of 6 1/2. Okay, so that's at least 4 ticks, stops at break even, yeah? Stops at break even at least on that one. But there is a macro context to all of these trades as well. There's a micro context to these. There's still a value context to these trades as well. And obviously, you're still in the middle of a cash open. So it's always going to be more dangerous to try and do these trades in the cash open than it is to let the first 15 minutes get out the way and then start doing these kind of trades. Because obviously, this is the highest volatility period, and therefore it is the highest risk period. These are easy money rotations when the market starts to settle down into its normal day's business. And obviously, inside of that storyline, you can also do what? Inside of a normal day storyline, you can also do what? You can also add in things like your real market rotations. You can add in your volatility. Inside of a normal day story, you can also add in what? Anything. You can add in any other element that you wish. You can add in any other element you wish. You could add in the rotational business, the beta narratives. You can add in the volatility storyline. You can add in any other element that you wish. And obviously, there was another sellable opportunity there. You can see the Prem's been upticking. So with the Prem upticking on a blue candle like this and somebody's absorbing that candle, do you see that that's a sell trade there? Do you see that that's a sell trade? Does everybody see that sell coming in? And obviously, that's the absorption coming in. The only challenge you've got to that is it's well off the high of the candle. So obviously, you've given away some of the money on that trade. So you want to make sure you just ask for that extra money back and then try and sell on an uptick. You don't want to chase it because you've already given away a lot of the money on that. And obviously, the idea there is to try and sell into this as this candle formed. And now when that candle formed, you can see the ticks going up and the Prem's going up as well. So obviously, there's no way that price is going to go any lower, right? So obviously, if you wanted to kind of go for a fresh air buy, you'd have been buying the low of that candle as a fresh air buy. Different type of trade, doesn't make any difference. But as a fresh air buy, you can recognize the buy trade at the bottom. And obviously, you can see that the opportunity to rotate from the sell into the buy and press, you can see that this is a very fast money strategy. It's not for the slow traders. It's not for people that need to overly think the trade out. It's a fast money strategy. But do you see the buy on this candle as well? Because this is a low price on this candle, that's actually beneficial. So we could obviously look at that buy trade there with the tick up ticking aggressively and the price having a heavy discount. And we don't just see the discount because of where the price is. We see the discount because of where the Prem is. So the future is massively discounted to the stock market. And that means that we've got a real money edge to buy into this, right? We've got a real money edge to buy into this discount. And there's your buy trade into the close of that candle. And obviously the takeaway from that trade has gone from 44s and it's now trading 48s. That's a $200 upside in 1 minute. That is a very nice trade. Now, obviously, this is a fresh air high, so you want to bag some monies. It's not the same as an absorption trade, but it is a fresh air high, so you want to bag some monies here, get some of that money out the trade, and that's a very nice floor trader scalp, isn't it? Very nice. So if the tick continues down, what's going to happen next is if the Prem then goes higher, you're going to start seeing a premium coming back in on the S&P futures. So that's something we can start watching. We can start watching as a storyline. We can start thinking about as stories. And obviously, we can start trading when we see it. Obviously, you'll get to know what a good trade looks like and what a poor trade looks like. And there are indicators. I mean, they're not brilliant by any means, but there's some indicators that will show you absorptions. But these are basically price action type indicators. A lot of the time they get the absorption the wrong way round because of the color of the candle and the size of the pin in whichever direction you're seeing. So we can obviously see absorptions coming into these. This is just an indicator called absorption. But you'll see in the screenshot that I showed you earlier, the two trades that I showed you had that absorption visible. So you can see, for example, here, they had the absorption visible on both occasions. You see that? You'll see that there was an absorption there for that sell trade, and there was an absorption there for that buy trade. So again, this can be something that you can add if you needed to add anything. This is something that you could add to the story of absorption, isn't it? It's something you could have added to the picture to make the trade that little bit more systematic, because with a little bit more systematic, you're taking away some of the pressure for you to make that decision. The downside of that is you're based around the trade rules that the programmer has put into that signal. Yes? It's based around the trade rules that the programmers are putting into that signal. So obviously, if you were to look for a trade, the idea of what the trade would be, you can obviously recognize that you've got to get that discount price, you've got to get that absorption price. You can obviously recognize, for example, that sell trade on this trade here. You can see that that sell trade there was the kind of trade you'd then be looking for, because it's got the absorption, it's got the prem up ticking, it's got the tick down ticking, it's on a blue candle, selling into that for that rotation, and you can see the money was made. Hold on a second.